These are 3 stocks that you may wish you had bought last summer, but everyone was too obsessed with the negative news surrounding them. If you're new to our channel, what I try to talk about is a process on fundamentals to buy companies. But most importantly, it's all about the emotional fortitude that you need to have, that when you see a company that you love fall in price, you're able to buy more. These 3 companies, 3M, Disney, and Target, all last year had immense negative news. Disney and Target were being harassed for their wokeness. Now, guys, keep in mind, this video is being made on a short run basis of the stocks rebounding. So keep in mind, I don't know where the stocks are going, but it's just to show you that in the short run, anything can happen. And usually the news that'll occur that'll drive a stock up or down in the short run won't last forever. This is something I preach all the time. It's why I preach don't fall for FOMO and hype. It's why I preach handling your emotions. When the companies that you love based on fundamentals fall, you should look at as a buying opportunity. But I have a little secret. It's easier said than done. It's simple and not easy. All 3 of these stocks are stocks that I own. And all 3 of these stocks, and you'll see shortly, had terrible news behind them. And the comments about me when I bought them were just terrible. Now, with that said, they could go to even new lows. I hope they do, because now the news is better on them. And if they go to new lows, guess what's going to happen? The news will turn again, and it'll be even worse. And the question you need to ask yourself is the news about them really about the company or just some temporary BS? Another example I always give is Alibaba. For the longest time, you know how much I heard about ADRs, which is you don't actually own the company and you could lose the shares in the US. That was all the rave about Baba. Now it's nowhere to be found. Nobody talks about that anymore. Guess what? It's still the same risk it was when the hype was so big. So guys, let's take a look at this. Now 3M is interesting. Why? Because they're at $95 a share. That's after a spinoff. They hit a high back in 2021. Is that their all-time high? No, 2018 was their all-time high of $217 a share. In 2021, they hit a high of $174 back in May of 2021. They're now at $95 per share. What was the low last year? $71.35 in October of 2023. That's up 30% since then. Now, does that mean it's not going below 71? Guys, I have no idea where anything's going in the short run. No clue. If you've followed our channel before, my thesis is based on 3 questions. When I buy a company, first my question is, do I see this company being around for the foreseeable future? When I say that, I mean 10, 20, 30 years and beyond. If the answer is yes to that, I go to the next question. Will their profit and revenue likely be higher in that future time period than it is today? If the answer is yes to that, I can reasonably assess that. The third and most important question, can I pay a reasonable price for the company today that pays me for that risk and gives me an ample return on my money? That's my underlying thesis. It sounds simple, and guess what? It is. I look at 3M, I look at Disney, I look at Target. I would be shocked if any 3 of these companies were not around in 20 years. Now remember, like I said, just because I own these companies does not mean you should buy them. You need to make sure that you use this channel for learning a process and applying that process to what matters to you. We want to teach the fundamentals, and then, but most importantly, it's about using the fundamentals and the emotions to buy a good company as prices get better. Warren Buffett always says it. He feels best when stock prices are going down. Isn't that a way you want to be? I heard that 20 years ago and I was like, damn, I'm not like that. And over time, and it was a lot faster than 20 years, but you have something way more valuable to you than I did 20 years ago. You have YouTube. You have other like-minded people. It is hard to sit there and see a stock go down. 20 years ago, when I saw my stocks going down, I was filled with fear. I remember just laying there going, are these going to zero? I really, truly believed that. 20-some years ago, it was more than 20 years ago, I thought stocks were going to zero. Does that make any sense? No. The stock market's not going to zero. An individual stock could go to zero. We're all going to have those. Peter Lynch has had those. Warren Buffett, I don't know if Warren Buffett's had those. I have no idea, but the point is, it will happen. What's most important, though, is that you're able to apply a good process to several investments. And over time, those investments should do well if you're able to handle your emotions. And big part of handling the emotions is when you see the stock fall, go back to the fundamentals and continue to buy if your thesis is still the same. Now, the difference between 20 some years ago and today is, like I said, you've got YouTube. You've got a community of like-minded investors. We've got thousands of people in this community growing every single day that sit there and handle their emotions better than most. Everybody's still learning? I'm still learning how to handle my emotions. It's tough out there. But I look at Target, I look at 3M, I look at Disney, and I literally hope that they fall in half. And that is an honest to God fact out of me. Give me a lie detector test right now, and if they said to me, do you want these stocks to fall in half? I will pass with flying colors. I will pull an anti-OJ. I will pass my lie detector test. For those of you who don't know, OJ got the worst possible score on his lie detector when they asked him if he knew who was responsible for Nicole and Ron Goldman's murder. But I digress. The point about this all is, if you want to have like-minded people around you to help you, because it can be lonely, join the community. Click the link below, $7 for 7 days. It'll help you feel a lot better. And if you can handle your emotions, guess what's going to happen to your returns? They're likely to increase. So I encourage you to do that. With 3M, it is down 36% in the last 5 years. So if you're a 3M investor, you're like, even with the dividend, you haven't gotten that money back. You've sucked. 10 years, you're down 19%. Now with dividends, you've made a few bucks. But remember, don't look at where the stock has been. You want to look at where the stock could go based on analysis. If you only look at where stocks have been, you'd have missed out on NVIDIA. You know, NVIDIA, right before its big run-up, fell 50%. If you care about where the stock has been, you would have never bought NVIDIA. What it's about is looking at price versus value. And whenever value is above price, that's when you need to take a look. You look at Disney here. Look at Disney. Disney hit a high of 202 in March of 2021. Since then, it hit a low of $78. 78 bucks. Look at it now. After a big fall yesterday, it's at 105. That's up 40%. It's a big number. Now, again, I don't know where Disney's going, but I have a thesis on Disney. Let's pull up our good old friend Target. Target, all-time high of 250 back in November of 2021, hit a low of 101 back in October. Guys, I was even looking at it. I was buying sub 135. I bought from 135 all the way down to 105. I didn't get to buy it at 101. Okay, but if it had gone to 90, I'd have bought along the way. Why? Because I believed my thesis on Target. And my personal goal, the goal that I want you to get acclimated around, is buying several companies at better prices. Okay, so here's some of the comments in our YouTube channel. This is about Disney. I'm so soured on Disney. They've destroyed it. That was 8 months ago. Since then, up 10% in terms of revenue at their parks. Another couple of ones. When you go woke, you go broke. It's a very common one. They're commenting here, a long comment about DreamWorks, all that stuff, and 100% that's why I'll not touch the stock. Nate Bro here says that's why half the other investors are thinking this could contribute to why make it a good deal. And Nate Bro wrote, and Danny Brooks wrote back, too many other good stocks to buy for me. So I like the fact that some people are defending, but the whole go woke, go broke thing was a very big thing. And to people who believe that, I sat there and said, then why are their parks revenue up 10% year over year? 10%. Okay, for Target. Target's going to struggle with their woke approach, another woke approach. You should remake this video now that they're selling satanic trans swimsuits for 8-year-olds. That was 11 months ago. Disappointed you guys are giving out bad advice on Target. I thought you guys were okay. Now I'm thinking that you're giving out bad advice, being nice, stating it this way. Thank you very much, Randy. Everyone's slamming them. Research them. So, Randy, everyone is slamming them. That's my first indication that it might be exaggerated. That might be. Now, granted, Target is suffering a little bit on their same store sales. I get that. Don't get me wrong. Just like Disney suffered on things, but is it still a convenient thing? And guess what? A lot of women still like Target. Just not a good business. Costco eats retail. Okay, I don't think comparing Costco and Target as a business model are the same thing. Look at parking lot, it's not packed. I disagree. I drive by the parking lots and they're packed. I went to Target just a week and a half ago down in Dallas on an outside suburb, and it was jam-packed. And we walked inside, and it was busy. We had to wait in line. So maybe that's me. 3M, it's a value trap right here. Guys, everything is great in stale LBM, but you didn't talk about the main issues. Hey, I appreciate that. A lot of comments up here about it. And again, guys, you got to remember, this is only 1 year later. Who knows what's going to happen? Who knows? But I will say this. If the market goes down 30% and these stocks fall along with it, you can't sit there and say, see, I'm just looking at this going, okay, price and value. Every investment's the present value of all future cash flow. 3M, Disney, Target. I'm looking at these and all these people are really upset with them. And I sit there and say, would I be shocked if any one of these companies is not around in 20 years? Absolutely. Does that mean it can't happen? No, of course not. The point is I'm trying to buy companies that I perceive to be very good companies that have staying power at the right price. And the right price is more likely to happen when this is occurring, not when the comments are filled with, this company's great, they're changing the world, blah, 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 blah. Everybody's optimistic. You have to think differently to do well in investing. And guys, in the media, it was in on this hate too. This is actually one with a positive twist to it. Target just went from great to bad to ugly, but the worst may be over. This is August of 2022. The worst wasn't over. But here's my point. This is what you need to see over and over again. You need temporary negative sentiment against a company in order for there to be an over-exaggeration drop in price. This is something that the true investor should want. I'm not talking about a secular shift in the fundamentals of the business. I'm talking about a temporary problem in the company, especially one that is over-exaggerated. And problems tend to be over-exaggerated. And by the way, it worked. Target CEO admits Pride boycott worked. Guys, it works. But again, is the Pride boycott going to be on forever? That's my question to you. If you believe that Target forever will be affected by this boycott, guys, I'm already seeing the shift from people on tipping, the shift from people on even liberals, even the left is getting sick of the woke establishment. I just don't think it's going to last forever. And because of that, you have to look at it and say, Target fell to $103, $104 a share. And based on present value of all future cash flows, it made sense to me. So let's take a look at these companies now and see what they're worth to us. Let's look at Target. Stock's currently at 160. Analysts expect big jumps in profit here. They expect profit to go from $8.40 per share to $12.26 per share in 2029, basically end of 2028. Revenue growth, low to mid single digits, nothing major. In fact, flat or low for the next year. All right, not great. Let's pull up Stock Analyzer tool. Let's pull up Target and the last time I did it. When was the last time I did it? March 11th. I'm going to do this. I'm going to do 2.5%, 3.5%, and 4.5% revenue growth. Profit margin, I'm going to do 3.75, 4.25, and 4.75. They crush it. Free cash flow, I'm going to do the exact, I'm going to do a little bit lower free cash. No, same free cash flow. Same free cash flow. And PE, what's the PE I'm going to assign? I'm just going to do 15, 18, and 21. 15, 18, and 21. And again, guys, I'm doing a 9% desired return. This means no margin of safety. I just do this here to show you what, based on my assumptions, essentially what intrinsic value is. What would the stock get if it matched the market? I hit the analyze button. All right, I have 128 on the low side, 230 on the high side, 175 in the middle. That means if you paid today's price of 160, based on a discounted cash flow, you can expect 10% per year, and that includes the dividend, all right? So it's probably fairly priced, maybe according to my numbers. All right, let's go to the next company. Let's pull up Disney. Remember, my thesis on Disney is that their profit margin is just very low for where it should be. So the last time I did Disney was just a few days ago. Again, I did 3, 5, and 7% revenue growth, 9, 12, and 15 on the profit margin and free cash flow margin, 18, 21, and 24 for future PE and price to free cash flow, because I think it's a premium company. It's got a great Rolodex of movies, of characters, et cetera. They have the amusement parks. I don't think it's going anywhere. Hit the analyze button. I have a low price of 75, high price of 205, middle price of 128. So if you pay 105 today based on discounted cash flow and my middle assumptions, am I going to make 11.5%? All right. Again, this is not set in stone. We don't know the future. That's why you need margin of safety. We're humans. We make mistakes. We don't know the future. This is essentially a big part. 3M. Now, for 3M, let's pull it up. Now, this one's going to be a little difficult because 3M's numbers changed. They just spun off a company. But I did 1, 3, and 5% revenue growth, 10, 12.5, 15% profit margin. Free cash flow is actually better than profit margin. which I like, but also they had a big write-off last year because of their lawsuits. 15, 17, and 19 for my PE, and 9% return. All right, I have a low price of 80 to 90, high price of 180 to 190, middle price of 120 to 135. Now, again, that's based on before the spinoff, so you have to factor in a discount for the spinoff. Guys, again, click the link below, join the community. It'll help you become a better investor. Thank you for your time.